friends. Welcome back to the Skinny on Wall Street with us, the Wall Street Skinny. I'm Kristen.
I'm Jen.
And we are trying to jump through a number of hoops to make this happen. There's been so many deals going on. So we wanted to do the Skinny on. But as you can see, I'm here trying to feed this kid. Jen, I think, has COVID. She was like, I have razor blade throat. And Jen, I know that you are just sort of a little bit dying.
My last week in Switzerland. So next week when we record, we'll be back on the same time zone. It's 90 degrees here and I'm bundled up in a blanket and a sweatshirt, but I refuse to complain about my circumstances because you are the one who's juggling multiple humans to do this. And so I'm so grateful for you making this happen.
Well, no, I mean, again, I'm so lucky because I have an amazing nanny who's literally like trying to make me food in the other room. But I had to go drop off my kids at camp this morning. And of course, I don't know why it took an hour. So in the time that, normally it would be like a 5-minute drop off and it was just like so backed up. So she's been a saint. We also have like my 3-year-old. So this just, I remember when I was saying, I was like, we could totally do industry. It'll be no big deal. Like we'll have hours to.
I never believed you for a second.
I'm just a psychopath. So
We'll get there when I'm back, when we're back in a routine, back in the same time zone. But I knew nothing was going to happen in 6 months. I think what we've done has been nothing short of a miracle.
Well, again, and the other reason that this has been just obviously like a challenge is when I wake up in the morning, you're already 6 hours ahead and then you have camp pickup. So it's like trying to get anything done in this window is obviously fun. But last week, there were a couple of consumer retail M&A, or I should say reverse M&A deals that have gone on. And so we wanted to talk a little bit about these. So most of us are familiar with Kellogg's. I put a post up yesterday because the amount of Kellogg cereals that we have in our cabinet is embarrassing. And I guess cereal consumption is down something like 17% since 2019. And someone was like, yeah, it's because cereal is totally devoid of any kind of nutrients. And I was like, disagree. And just because during my pregnancy, I was anemic. So I was like actually trying to eat. The cereals are like quite iron fortified.
Fortified with iron, right?
Yeah.
Well,
so they're like
about this more broadly. You had put me onto a podcast a few years back when we first started this that I didn't get into, but for this episode, I actually listened to one of their episodes. It's called Maintenance Phase, and they did an episode about ultra processed foods. Did you listen to that episode?
I did, and I really liked it, actually. Yeah.
And I think it's such a timely piece of research or wrinkle to add into all the conversations we're going to have today, because all of the companies that we're talking about for the most part in this consumer retail space are impacted in one way or another negatively by the perception that ultra-processed foods are bad for you. But what was so interesting about that podcast episode that I listened to, thank you to your recommendation, was they were like, it's like pornography. When you break it down, you actually can't define what ultra processed actually means because there's so many things that we think of as healthy that are actually over processed. They're like, just call it junk food. Like if you want to assign some kind of categorization to food you don't like or want to judge, call it junk food and move on with it rather than calling it ultra processed, because there are things that are ultra processed that are bad for you. There are things that are ultra processed that are good for you. There are things that are not processed at all. They obviously use the extreme example of and there's cyanide in apples. And it's like, well, okay, that's not really like a relevant argument.
It's formaldehyde in your body. Yeah.
They had so many other arguments in that made me think twice about, I really do think we've started to use that as just code for judgment about food, thanks to the preponderance of the wellness industry. So we can talk about that more over the overall framework. But I think that's an interesting theme to be woven in, that somebody had such a strong reaction to just an Instagram story post that you made. And they can go eat whatever they want, right? Don't eat cereal. That's totally fine. Eat cereal, totally fine. Choose organic cereals, whatever. I remember a huge study came out a couple of years back that a lot of the organic cereals actually are super high in lead, that there are all these things. So it's so not cut and dry, but the wellness industry has really impacted these specific consumer brands. And it's interesting to see how that's now shaping the M&A landscape.
Yeah. I feel like we could do an entire podcast on that. I mean, it actually is really funny because when I was pregnant with my second, I have a history of obviously being very into the wellness industry, and I've sort of come out of it. Now I'm just sort of whatever. But at the time, I remember I was taking this prenatal, it was Seeking Health, and there was literally 8 vitamins because it was all like based on actual food. And it turns out that it ended up needing a warning. Like California has the like prop, I forget what it is, like Prop 69 something, where about the lead, because basically like where they were getting a lot of the iron was from spinach and sweet potatoes. Yeah. And the lead levels in that is actually like off the charts. So the synthetic stuff in like your generic prenatals was lower. So anyway, like there's so much with that, but the takeaway is historically we have Kellogg. And what's interesting about a lot of these consumer retail brands is that a lot of them like do a lot of repeated M&A. And so the other deal we're going to talk about is Kraft, and Kraft is also wild. We've spoken about it a little bit, but it's the Kraft Heinz anti-merger. It's a possible breakup. But again, like the genesis of like where Kraft came from and the history is so interesting. And again, like how Heinz and Kraft came to be is so interesting. So we're going to touch on that. But again, a lot of these consumer retail companies, it's huge M&A stories, like because under the umbrella of Kellogg, you have obviously Kellogg, you have Kellogg Corn Flakes, Frosted Flakes, Krispies, Fruit Loops. They have a whole bunch of cereals. They have Eggos, they have Pop-Tarts, they have Cheez-Its, Pringles, RX bars. And by the way, like a lot of some of the M&A they've done recently has been brands that are seen as like the organic, the clean, the minimally processed, all that kind of stuff. So a lot of these companies will have those types of brands in their portfolios. So if you go to Whole Foods and you see XYZ brand that you think is this like little mom and pop, it might be, but it also could be owned by one of these conglomerates. So anyway, the point is that back in 2023, Kellogg Company basically separated into two separate publicly traded companies so that they essentially focused on almost like the cereal brands and then versus some of the higher growth companies. And so the way that it shook out is there was Kellanova. So this was focused on global snacking and international cereals, as well as frozen foods. So it had the snack brands like Pringles, Cheez-Its, Pop-Tarts, Rice Krispies, RX bars, etc. They also had Eggos and Morningstar Farms, which is more plant-based. And then they had the separate Kellogg Company. And Kellogg, the focus was more on just the North American cereals business. So that was like your Corn Flakes, your Fruit Loops, your Raisin Bran, Special K, etc. And the idea is by separating these out, you unlock potential value. There is this concept called the conglomerate discount. And the other thing is you could potentially make these attractive M&A candidates or takeover candidates for other companies to come in and buy. And so what ultimately happened is, again, you had Kellanova, which had the high growth business that had a bid for Mars last year. So Mars was interested in buying them. I think it was for like a 31.
Sorry, I got it backwards. Mars was
No. Mars. Yeah. Mars is trying to buy Kellanova. I think it was something in like the $30 billion valuation range. Kellogg was much smaller. So the recent news is that we have Ferrero interested in buying Kellogg. And so the main thing from just sort of a learning perspective is to understand that when you do some of these public market separation techniques, like we've talked about in past episodes, you do have the potential to, again, unlock value, again, by making these possible acquisition candidates. Because by the way, in a merger, the buyer typically has to offer a premium to buy the business. So I think the premium that, in this case, Ferrero is offering is like Ferrero. 40% or something. Ferrero. What did I say? Ferrero. Like Ferrari. Yeah. I can't talk.
It's Italian. So, it's understandable.
Yeah. And Ferrero, by the way, is so interesting because they're, again, to your point, I keep saying it. I'm sorry, guys. It's might as well just, it's a Ferrari. Sorry. Ferrero, they are an Italian brand and they also have done just a ton of M&A recently. And it looks like over the past 10 years have done like 21 different acquisitions. And a lot of the focus has been expansion into the US. Market.
Yeah, because they're like a heritage Italian brand. In the US, people might be familiar with like Ferrero Rocher, but people might know Kinder a little bit less, which is huge in Europe. Like Kinder Bueno and stuff like that is ubiquitous in Europe. But they also have like Tic Tac and Baby Ruth. Like they have so many different snacks that are beloved, and they have a reputation, I think, as more of like a high-end candy. And there's something that I think has happened in the US subconscious alongside as like a parallel track with this wellness influence over the last decade or two, where, if it's European, it must be better. Even though it's like, it's chocolate, right? Like at the end of the day, it's chocolate. But there's this impression that they're like, these are more elite products than say like
definitely. Yes, definitely. But they have done just so many different deals recently, expanding their portfolio of consumer brands. And this is just sort of the latest. It's actually, I think, one of the largest at the, $3.1 billion range. So we were.
So just to be clear, so Ferrero is buying Kellogg, not
Yes.
Kellanova, not the high
Mars
growth
is buying.
stuff. Mars
Yeah.
is buying
And I do think it's
Kellanova.
interesting, that these historically chocolate brands are buying these, again, US based companies. You have Mars, which again, we sort of historically know because of, again, a lot of their chocolate stuff, although a significant amount of their revenue comes from like selling rice. Like they also have just a huge amount of different types of products. But then you have the Ferrero, which is now trying to diversify as well. And they're both obviously coming in and buying what is now the sort of two separate entities with Kellogg.
Do you have any terms
Yeah.
for the proposed purchase of Kellogg?
Oh, yeah. Ferrero is offering $23 a share, which essentially equates to a $3.1 billion valuation in terms of the equity. The current market cap before the deal was announced was close to $2 billion. I think that it translates, their EBITDA is around 293. So it was something like an 8.9 times EBITDA multiple, which is actually pretty low, but again, makes sense given the historic cereal downturn, just in terms of like sort of growth. The deal itself is an all cash deal, which was also the case with Mars. But Mars, again, we talked about in the past, and we will link the last episode. Mars is also a private company. Ferrero, I think Ferrero is private too. Not that means that they can't do any equity. We talked about that in that last podcast, but it is an all cash deal. Okay, so the other deal that was really interesting that was announced was basically Kraft Heinz is talking about splitting itself up. Now, what's interesting is that they basically came together not that long ago.
10 years ago.
10 years ago. I guess that actually was kind of long ago. It was not a great deal. And so I do want to go into some of the history here because there's a couple of, I think, interesting teaching points related to the history of Kraft. So fun fact, and I think I'd mentioned this in a past episode, but Kraft actually was born out of once having been part of Philip Morris, the tobacco company, now Altria, I think is how it's pronounced. I don't smoke cigarettes, so I don't actually know how to pronounce the name of that company. So we talked about these public market separation techniques in the past. And so in 2001, Philip Morris did what's called a carve-out, an equity carve-out. So they IPO'd a portion of Kraft, and then ultimately they did do what's called that spinoff, and they did ultimately fully separate. But they did that equity carve-out followed by a spin back in around 2001. So that was kind of the history of where Kraft came from. Now, Kraft did a number of acquisitions, one of which, and I feel like the one that has a lot of history, was when they went out and bought Cadbury. This was in what's called a hostile deal. It's interesting, by the way, because like we just have been talking about essentially European brands buying US businesses. This was obviously the opposite. It was Kraft going out and acquiring the Cadbury brand, and Cadbury did not want to sell. There was this amazing quote by one of the families saying, "We don't want to be sold to an American plastic cheese company." Now, at the time, Warren Buffett was a big investor in Kraft. Like, I feel like Warren Buffett has kind of been, he's liked Kraft for a while. Yes, but he likes Kraft. He's always liked Kraft. He likes the like sort of steady growth, cash flow.
I think he's nostalgic about some of the old school brands.
100%. So when they initially made the bid, Cadbury said no. So Kraft needed to sweeten the deal. And it was a cash stock mix, meaning they were both giving shares of Kraft to the Cadbury shareholders, as well as going out in the markets and raising debt. And to get the offer value up, they either would have had to borrow more debt, which they really didn't have the cash to do because they were already at a really high leverage ratio. And Warren Buffett, who had a significant investment in Kraft, was like, I'm not authorizing you guys to increase the amount of shares. So they ultimately had to sell off their frozen pizza business, and they did ultimately complete that acquisition. But not long after that, they then did a spinoff. So again, this is like the spinoff discussion, like rigor, whatever. So Kraft did a spinoff similar to why Kellogg did it. So they basically split into what's called Mondelez International, which is their global snack giant. So basically the brands were like Oreo, Cadbury, Nabisco, and then Kraft Food Group, which was much more focused on, again, the North American grocery business. So, okay, that's kind of the history with Kraft. Now, separately, in 2013, Heinz goes private, meaning you had 3G Capital, which we've also talked about in the past because who did they buy? I think it was like a shoe company recently.
Skechers.
Skechers, that's who it was. So we talked about that in a recent The Skinny On when all of the craziness about the tariffs was happening around Liberation Day. Anyway, they are a Brazilian private equity firm that is notorious for kind of having almost like ruthless tactics to cut costs. Yeah. But they teamed up with Berkshire Hathaway to do a take private, again, a leverage buyout of Heinz. So at the time it was a $28 billion deal. And so they bought the publicly traded equity for $23 billion. And then they assumed $5 billion in Heinz debt. That's where the $28 billion enterprise value comes from. But again, 3G Capital, I guess, put in called $4.25 billion. Berkshire Hathaway put in $8 billion. And then the rest they did with new debt financing. So that was 2013.
Of that $8 billion that Berkshire Hathaway put in, because I do think it's important when thinking about why it's been such a disaster. I think something on the order of magnitude of $8 billion of Berkshire Hathaway's contribution was preferred equity. So they only did $4 billion in common stock, and 3G did $4 billion in common stock, but Berkshire had this big chunk of high dividend paying preferred equity that the other guys didn't, of that total $12.5 billion of equity contribution that they had together.
Yeah, that's something that Berkshire actually likes to do a lot. They really like doing preferred investments. In 2008, when they did a huge investment in Goldman Sachs, it was structured as preferred. He loves preferred. I think he did something similar with, the Wrigley Heinz deal. Or no, sorry, it was Wrigley Mars. Yeah, so when Mars bought Wrigley, that was another one. I forgot he was involved in Wrigley Mars. Yeah, by the way, so back to like, he loves these like consumer.
He's all across these deals. Yeah.
So Warren Buffett was sort of more providing the capital. He's almost, it reminds me a little bit of like a co-invest, if you will. It is the 3G that is doing the day-to-day operations. And again, going and, trimming tons of jobs, blah, 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 blah. All right. So fast forward to 2015. This is where there is what's called a reverse merger. And it reminds me a little bit of like when we talked about SPACs, where a SPAC is where you have a blank check company go public. So this blank check company is publicly trading. And then you have some actual private company, like a real company, but the private, by the way, the public company is a shell company. You have a merger. And so it's like a backdoor into going public. And so it's not exactly the same thing, but it's similar in the sense that when in 2015, Heinz acquired Kraft, Heinz was private, right? Because they had done the leverage buyouts. They were not publicly traded. Kraft Foods Groups was. Like we said, they had done exactly. So when Heinz bought Kraft, the end result was that Heinz shareholders, so that's 3G and Berkshire, they owned 51% of the pro forma business, whereas Kraft shareholders only owned 49%. But the way that it was structured is that if you were a Kraft shareholder, you got shares in this now new company and you got a dividend. I think it was something like a $10 billion dividend.
Correct.
And a reverse merger is just where usually with a regular merger, it's a public company that would buy the private one. Here, the private company buys the public. And again, it's almost like a backdoor into going public. But this is cited as like the textbook example of a reverse merger in like the large cap world. Like this is just So I loved that for that reason. It's like, we're talking about
that the reverse merger came from a company that had been more of a traditional LBO model, that had been something that was one of these really mature, right? Heinz was a 150-year-old company by the time it was bought. It was like a perfect candidate for one of these private equity takeovers. And then you have that as ultimately what then spawns this reverse merger. I wasn't familiar with that term, so that's really cool.
Yeah. So anyway, the ultimate takeaway though is that this was a terrible deal. Warren Buffett has admitted that he overpaid. I think that in 2019, Kraft Heinz took a $15 billion write down on a number of the brands that they bought. So this is one of the risks when you do any kind of M&A deal. I think that 3G got out in, call it 2023. And now they're talking about splitting up again. Basically, what Kraft Heinz said is that it has been evaluating potential strategic transactions to unlock shareholder value, which to many means they expect it to, again, separate, with the end result being they're probably going to separate along the same lines that they initially came together in, where it's like Kraft and then Heinz.
That's what I'm really curious about, TBD. Because the market likes this news. The stock was up something like, I think, 7% on the news. But here was my question to you. The history of these things is, okay, we're trying to carve out like the things that are growth friendly, that are more wellness palatable from the things that are the legacy brands. Well, when I think of Heinz, right, I think of and you think of Kraft Heinz, it's everything from like American cheese to hot dogs to stuff that comes in a bright yellow or a bright red bottle. It's not the stuff that's got the organic all over it that's made with unicorn tears. So my question is which is the carve out that is going to be more attractive for growth, and which is the one that's going to be the heritage legacy stuff, when they both seem to have the same type of branding?
Well, that's a good question. If you look at some of their brands, it's not so much that some is like the sort of healthier wellness. Kellanova, for example, I'm looking up to see if they have the actual breakdown of what the brands were, but they're not all like super healthy. I think it's just almost like the snack food, frozen, plant-based. And by the way, within their portfolio, I mean, Heinz does have, we buy the organic Heinz. I don't know if that's actually organic. Yeah, I will say unrelated. I was so sad because there was this amazing ketchup brand that I loved called Sir Kensington's. Well, they actually were started by two Brown alumni who were in my brother's class. Like my brother was friendly with them. But I guess like they sold to, I thought it was Heinz. I think it actually might have been Unilever. And then they got rid of the like commercial Sir Kensington. They got rid of the retail products. Like it's only available in like to restaurants. For the ketchup. You can't, the ketchup is no longer.
Interesting.
But that would have been perfect to your point, and it tasted so good. Anyway, so that's unrelated. So I don't know how they'll ultimately split it up again. I would want to see what their brands actually are. We're kind of going based on like, I know they have, Kraft products and then Heinz. Yeah, seriously.
It's also so interesting to have this all happening on the eve of Warren Buffett's retirement, effectively, that we're talking about one of his rare misses. Over the same time period as this investment, if he had invested the S&P, right, it would have gone from whatever it is, like 2,100 to 6,200. Like,
True.
This is a pretty big hickey in an otherwise, like, I mean, very successful long-term investing strategy.
Well, to your point, though, I mean, because of how he structured
they made money through the dividends. So, like, their total return has still been disappointing.
Oh, yeah. But again, not every acquisition was going to hit it out of the park. And also because he was an owner before all of this happened. Like, I'm actually so curious if like you were to look at how much money he made in terms of betting on this company, because it wasn't just during this time period that he was a believer in it. It was going back X number of years. So I am curious if you kind of look at it more in the totality that way. But I agree with you. He's so notorious for anything he does. You're like, this is going to be a good deal.
It's a home run. Yeah. And to critique my own comparison, you can't compare anything to just having owned the S&P over the long run. I remember talking to my husband about this. We were talking about the bid for the LA Lakers. The family that owned it paid $67 million for it back in the 70s and sold it for $10 billion. And they still underperformed by massive amounts what they would have made if they'd invested $67 million of 1970s money in the S&P. So like using that as your benchmark for everything, it's not a meaningful point other than to illustrate like just the exaggeration of how unfortunate it is that he was wrapped up in this investment, which hasn't been just a crown jewel of his portfolio, let's say.
Yeah. And to your point too, it's like no one with a lot of money is going to put all their money into the S&P. It's always going to be like, you want to make sure that you are adjusting for risk and like drawdowns and all that. And so if you did invest in Berkshire Hathaway, again, I do think you've actually outperformed the S&P, but yeah, it is a hard comparison, but
yeah, it's not particularly meaningful. I just use it for purposes of exaggeration here to talk about one thing we're critiquing Warren Buffett for, when I think we've never actually said a bad thing about a single decision he's ever made on here.
Yeah, seriously. Okay, so the last thing, I had sent Jen this article in the Financial Times today about how like we are now entering this extended period of dominance for trading over investment banking on Wall Street. And it's so funny because in the 2006-7 time period when you and I started our career, I mean, that's how it was, right? Is like trading trumps banking. And you saw that in the decisions that people made. At the time when I was thinking about going into finance, I thought of people going into investment banking as these morons who was like, why would you go into like a monkey business type thing? No, I'm serious. And that's why it was so funny when I actually got on the desk and I was like, I was in CDO structuring, so it's not really like
Yeah,
I was
you
in
were
trading because
actually, like,
I got the offer. Well,
Yeah.
the irony is my offer when I accepted was fixed income sales and trading. That's what I was accepted into. And then it's like, once you got the offer, then you would go and talk to different groups. And like I said, because I had this engineering background, as I was talking to groups, people were like, oh, she is more mathy, so that makes more sense for her. So we're going to put her on CDO structuring. Now, had I known more, and my option was CDO structuring or investment banking, and I actually knew what investment banking was other than what I read at Monkey Business, I'd have been like, this is not the right move for me. But I had no context of anything. So anyway, I want to put that out there that was how I got in CDO structuring. But at the time, again, sales and trading was definitely seen as like the sexy thing, the thing that smart people go into, blah, blah, blah. Post as we entered the ZERP era, Volcker rule and the ZERP era, with private equity kind of just like becoming this huge magnet for talent. And I think upping the ante by almost doing some of the things that we talked about last episode, where it's like you push the recruiting, you make it seem like it's this really hard to get thing. So like the best of the best are like, ooh, this is harder to get. I want to go do that.
PR. Yeah.
Yes. And so because of that, I think there was this shift from a talent perspective to pursuing more investment banking. But people ultimately want to go where the money is. And so if we're now in this era of investment banking, massively underperforming sales and trading, and then also private equity potentially having a harder time, I do wonder if there's going to be, again, that shift back into more people trying to kind of go the sales and trading route. I do think one of the things that people are up against is like just not understanding what the heck it actually is. But anyway, I'm curious to hear your thoughts.
That's what we're here for.
That's fair.
No, and I think your story, the analog for that today is the number of people who are like, what do I got to do to become a quant? I don't think that word means what you think it means. If you think being a quant is going and working for Pete Muller at PDT or Renaissance, Rentech, like, you are sadly mistaken. Those are a handful of the most blue chip, prestigious quant funds out there, that if you think it's hard to get a summer investment banking internship at Goldman Sachs, these are so many orders of magnitude more competitive, more high stakes, looking for an extremely, like the Liam Neeson, like a very specific set of skills. And to be honest, there's like, you can probably count on one hand the number of people who have them, like at any given point in time in any major financial city around the world. These are the most elite of the most elite of the most elite. If that's what you want to do, God love you, go for it. Like, I wish you all the best. But that's not the kind of thing where there's an analyst class of 120 people and then you're all going to learn the same skill set and then you're all going to go interview for these quant hedge funds. That's not how it's going to be. There are quant roles across all aspects of Wall Street, but most of them are actually support functions for the more traditional sales and trading and research and investment banking and private equity investing and hedge fund trading and blah, 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 traditional roles. Very few of them are that super elite level where you're the one writing the algorithm that's going to be printing $180 million in comp for you every single year. So I just want to be very clear that I think there's almost an analog now for how you thought about CDO structuring or sales and trading, or what people thought they were getting into. You might have thought, or you might hear people talking about like, oh my gosh, okay, like hear about the John Hoffmans and you hear about all these people who are like prop trading, they're going to crush it. I'm going into sales and trading because this is the path to greatness. Well, okay, within sales and trading, there were some really effing boring desks like CDO structuring where you were like, I'm quanti, doesn't that mean I'm going to be the best? And they're like, actually, no, we're going to go stick you in a library. And we're going to take the other people who have a different set of skills and put them in this much more boring role. So I think there's of an analog to that with what's happening with people who think that quant is so sexy right now and what the quant opportunities actually look like. I'm not saying they're bad. I'm not saying you can't have an amazing career, but I don't know that that word means what you think it means in terms of what the career path looks like.
Yeah. No, again, the thing that was so wild with Morgan Stanley is like the two groups that I had them high on my list, they had me high on my list. It was CDO structuring because again, I was like, ooh, this seems like technical. And the other one was basically a private equity group. That's what my roommate Kira ended up going into. That it was like you were actually walled off. And so you weren't on the trading floor, but you were doing more private equity investments. So she went through the training with investment banking. And that's why I was like, oh, that seems so much more interesting.
Right.
I'd much rather be doing that.
Fit for you from the jump had gone into that. But also the fact that was like a vertical within sales and trading hiring is wild.
It was because it was like Mitch Petrick's It was like his baby. Like he was,
There's
And
that.
so,
And there's also the lines used to be so much blurrier within the investment banks. Remember we talked to Zoe Cruz, and the FX desk used to sit under IBD, right? So like history is wild when you think about these things that seem like they're so firmly defined. Not at all. And by the way, they will continue to shift as the political whims within each of these banks. It depends on who's in power, and it depends on who likes whom. Right? Because at the end of the day, everyone wants their vertical to be the one putting up the big numbers. So if there's some desk over there, right, and your vertical is vulnerable, we'll come move you into our segment of the bank and figure out some flimsy excuse for why it should be there. So like things are never as set in stone as you think they are. What the sexy career is never as set in stone. So for the daily DMs that we get being like, should I go to this desk, or what's the best desk to go to? It could literally change from today to tomorrow. It is what is the best desk for you? What is interesting to you? We can't say that enough. We've been saying that. We're a broken record since time immemorial of that's what's really important to seek out. And we've seen in our, we did a big Ask Me Anything about like internships earlier this summer. We've been communicating so much with so many of you who are in the thick of it right now. And so many of you are finding through this process that what you thought you wanted is not what you wanted. And that's supposed to be okay. That is supposed to be how it works, that you're supposed to try these things on in a low risk way and figure out whether or not you actually like it, not just be gunning for the return offer so you can like enjoy the rest of your senior year. The problem is because of these hyper accelerated recruiting cycles, you no longer get to have that like 30-day risk-free return policy on your summer internship. It has to be like return offer or death. With these private equity firms giving this signal to everyone that it's okay to pump the brakes a little bit, I certainly hope that everyone else is going to follow suit. And I think if that starts to flow down through the channels of everything else, not just that recruiting cycle, but also of the investment banking internships, or if the case is going to be that you need to decide your freshman year what you want to do, make more formal programs available to people younger then. Because it's like, okay, you need to prove by your sophomore year that you've wanted to do this your whole life. Oh, but there's no formal freshman internship program. You needed to have an externship that you crafted with your gumption and your know-how and your networking. It's like, oh, come on, right? If you didn't know, you didn't know. So anyways, end rant, but it is interesting to see how these things shift. I do think one thing that we've had just as an overall phenomenon since '08 is a shortening of market cycles. So while IBD and investment banking deal flow and things like that may be on the back burner for now, I expect it won't be too long. Everything just evolves faster, right? We get through market cycles much faster. So whatever it will be, whatever the catalyst will be, Scott Bessent today was urging Jerome Powell to step down as Fed chair in May when his term is over. It's like, first of all, I don't think Jerome Powell wants to do this anymore if he were to stay. I think it would be because of spite at this point, like, truly. I don't think he wants to deal with these people. But you know, if we get someone in there who is going to cave to the pressure for lower interest rates, all of the volatility that we're seeing in the public market and all the juice that is enabling sales and trading to put up such high numbers and is keeping M&A activity on the back burner, that could flip from one second to the next, and we would have a 9-month cycle instead of a 9-year cycle. Really, nothing is set in stone, and so don't be following those whims when it comes to your career.
Yeah, amen. And I did lie. There was one other thing that I just wanted to quickly touch on, which was XAI going out and fundraising and seeking a $200 billion valuation. And so I just want to put that in context because, I mean, it was earlier this year when XAI,
I remember
it actually might have been.
Spring.
It was spring, to your point, when XAI and X merged. And part of the justification for the valuation of XAI at the time, because it was this weird, you can go back and listen again. We'll link that podcast too. But we should
repost that video that you did. You did a great explainer video about it, didn't you?
Yeah, I did a whole video on that. But again, it's less relevant now. It's just more interesting with regards to sort of the valuation. So the whole idea is that you had two private companies where the valuation is kind of made up. And so they were doing this merger and they were combining in stock, which again is really just about like, what is the relative value of these two companies that are private? And the valuation for, I forget if it was X, I think it was for X, but could have also been for XAI, was based on a funding round that like Elon Musk had participated in. He's also like so it was just sort of interesting. But at the time, the combined business was valued at $113 billion. Now it's up to like $200 billion. With that said, apparently like Grok 4 is doing very well on all these, AI tests. At the same time, literally earlier this week, Grok, had very anti-Semitic comments, and he had been like, it's going to be less woke. And then it was sexually harassing Linda Yaccarino, who's stepping down. And no, I don't think so. There was a meme that said like it was Grok that hacked Elmo, but it was a meme. It was making fun of what happened again, which is also awful. So like Elmo was hacked, the Elmo account, and again was posting vile things on I think on X, although
Twitter,
on Twitter, yeah. But the Grok model, they've fixed whatever issue was at fault. But anyway, it was just sort of an interesting like timing of things that I guess they did have a model that has been doing very well. Elon Musk has been throwing tons of chips and compute at the problem and all that stuff. And again, his model relative to like ChatGPT or Anthropic and the Google one, who I forget what Google's is, Claude, Gemini.
Honestly, I don't use any.
I can't get them all straight anymore.
Yeah. I'm just waiting for it.
Yeah, I can't get them straight anymore. But I always, as a numbers person, am like, okay, back when this deal happened, this is what the valuation was. Okay, what is it now? And how does this compare? So $200 billion, I think OpenAI had raised at 300 or 400 billion, depending on some of the details with how things go with SoftBank. So anyway, just wanted to add that color in there because obviously it's an important news story. So I think that's everything.
Awesome. Well, we made it.
We did it. 10:40. You have a few minutes before you have to go get your kids, but it was fun to catch up, Jen. I got to go see if this guy needs to eat again because
this time next week. So I'm excited.
Oh, I didn't realize that.
Be back on the same. Well,
me
maybe
too.
Not this time. In my mind, it's Thursday because I'm on so much cold medicine that I truly don't even know my name. So I'm excited to be back on your time zone. And we also have some exciting staffing announcements coming up if we want to mention that at some point. But we'll leave that for later. And a newsletter coming out in 48 hours. And we'll talk to you guys soon.
Awesome. Thanks, guys.
Bye.
Bye.